If you're tuned into the commodities world, you've probably noticed silver is on an absolute tear right now. Prices have smashed through record highs, doubling over the course of 2025, and the Shanghai Futures Exchange just stepped in with some big changes to try and keep things from getting too wild. In this video, we're breaking down the latest moves on margins and price limits, the surge in physical demand, dropping inventories, and how China's upcoming policy shifts could ripple through global supplies, all based on what's happening as of mid-December 2025. Stick around for the full picture on this silver frenzy. Just a quick note before we dive in. This is all informational, sharing facts from recent market developments. I'm not giving any investment advice here. Everyone's situation is different, so do your own research. All right, let's start with the headline news that's got everyone talking. On December 12, 2025, the Shanghai Futures Exchange announced adjustments to cool off the overheated silver futures market. They bumped up the daily price limits to 15%, which means contracts can't swing more than that in a single trading day. At the same time, they raised the trading margins to between 16 and 17% for silver futures contracts. These are some of the highest levels we've seen in years, and they're effective from the closing settlement on that date. The goal here seems to be stabilizing the market amid all this volatility. When prices rocket like they have, exchanges often step in to prevent excessive speculation and reduce the risk of big crashes. Why the need for these changes? Well, silver prices have been climbing relentlessly. As we head into Monday after that announcement, spot prices in Shanghai were holding steady around 14,900 yuan per kilogram. To put that in perspective, that's equivalent to roughly $65 per ounce, give or take depending on the exchange rate. And this isn't just a blip. Silver has more than doubled since the start of 2025, hitting all-time highs near $60 per ounce on the global stage. On the COMEX in the US, for instance, silver touched $59.645 per ounce just recently, up a staggering 100% year to date. It's outperformed pretty much every other commodity out there, surging over 10% in just the last week alone. A big part of this story is the physical demand staying incredibly strong, even as prices climb. Reports are coming in of distributors selling out fast. One example highlighted 5 metric tons of silver bars gone in no time at a major outlet. That's not pocket change. It shows real buyers are snapping up the metal, not just traders on screens. Inventories are dropping sharply too. At warehouses linked to the Shanghai Futures Exchange, stocks have hit their lowest levels in almost a decade, down to points not seen since around 2015. Globally, the free float of silver, the stuff actually available to delivery, has plummeted by about 75%, from 850 million ounces a few years back to maybe 150 to 200 million now, according to metals analysts. This tightness isn't happening in a vacuum. Traders and market watchers are pointing to a mix of factors fueling the surge. On the monetary side, silver's acting like a hedge against uncertainty. With inflation lingering, big fiscal deficits in major economies, and central banks like the Fed cutting rates throughout 2025, people are turning to hard assets. Trust in fiat currencies has taken a hit, and silver, being cheaper than gold, offers a higher beta play, meaning it moves more dramatically. The gold-silver ratio spiked above 105 earlier this year, making silver look undervalued and not drew in speculators and long-term holders. In China specifically, weakness in the property sector has pushed folks towards silver and gold as stores of value. Then there's the structural side, which is huge for silver, because about 58% of global demand comes from industry. We're talking solar panels, electric vehicles, data centers, AI hardware, and electronics, all sectors booming right now. Silver's unmatched conductivity makes it essential for these tech transformations, and demand here is pretty price inelastic. That means even as prices rise, manufacturers keep buying because silver is just a tiny fraction of their overall costs. The Silver Institute projects ongoing growth in these areas through 2030. On the supply end, though, it's a different story. Mine output is mostly a byproduct of other metals like lead and zinc, so it doesn't ramp up quickly in response to higher prices. The World Silver Survey is forecasting a deficit of around 120 million ounces for 2025, marking the fifth straight year of shortfalls. Add up the past 5 years, and we're looking at hundreds of millions of ounces in cumulative deficits. Physical market stresses are amplifying all this. There's been a historic short squeeze where those betting against silver get forced to cover, pushing prices even higher. Lease rates in London have stayed elevated, signaling tight availability. In India, demand for silver jewelry and investments has exploded as gold prices hit records, leading to a shift that strains global supplies further. And in the US, silver's addition to the critical minerals list earlier this year prompted massive shipments into American warehouses. Think precautionary hoarding ahead of potential tariffs under the new administration. That pulled metal out of circulation elsewhere, creating dislocations. Speaking of the US, let's touch on what's happening at COMEX because it's connected to the global picture. In the first 4 trading days of December 2025, over 47.6 million ounces of registered silver were claimed for delivery. That's more than 60% of the total registered inventory drained in just days. Since 2020, COMEX vaults have seen a 73% depletion overall. This kind of vault drain echoes past squeezes like the Hunt brothers incident back in 1980, and it's sparking talk of prices potentially pushing toward $80 per ounce or more if physical scarcity persists. We're seeing backwardation in contracts, where near-term prices are higher than futures and physical premiums soaring. It all points to a disconnect between paper markets and actual metal availability, which could lead to more volatility or even cash settlements if things get too strained. Back to China, where a lot of this action is centered. The manager of China's only pure-play silver fund has been warning retail investors about the risks here. With prices doubling and funds trading at record premiums over the underlying contracts, it's a sign of heavy speculative positioning. Those premiums suggest paper claims are outpacing deliverable supplies, which could trigger sharp pullbacks if margin calls hit or regulators step in. The fund's seeing massive retail inflows, but the manager notes silver's dual nature as both industrial commodity and monetary metal makes it way more volatile than gold. Manufacturers are feeling the pinch with higher costs, but long-term, clean energy trends should support demand. Looking ahead, traders are noting that these exchange changes in Shanghai might shake out some speculators in the short term. Higher margins mean you need more capital to hold positions, which can force weaker hands to exit. But on the horizon, there's added worry from China's upcoming silver export curbs starting in January 2026. Details are still emerging, but restrictions on exports could tighten global supplies even more, especially since China's a major player in both production and consumption. This comes on top of existing deficits. The market's already projecting another shortfall in 2026, potentially around 95 million ounces, if industrial demand holds but dips slightly from 2024 peaks due to price pressures. Overall, this 2025 rally has been driven by that perfect storm: monetary hedging, industrial must-haves, and physical squeezes. ETF inflows have been massive too, up 18% to 844 million ounces held, and while speculative net longs on COMEX have dipped recently to 152 million ounces, that lean positioning could set the stage for more buying if momentum rebuilds. Technically, if prices consolidate above key levels like $54 to $55, we might see a new higher trading range. But risks are there. Policy shifts, like if US tariffs don't materialize as feared, could ease tightness. Or if AI hype cools, demand for data centers might soften. The gold-silver ratio is back around 68, in line with long-term averages, so silver isn't the screaming bargain it was earlier. Wrapping this up, it's fascinating to see how silver's evolved from a monetary hedge to an industrial powerhouse this year. The Shanghai moves are a direct response to these record highs, and with physical demand staying robust amid low inventories, the market's in a delicate spot. China's export changes next month could add more fuel to the fire on supply worries. And hey, just to close out naturally like we're chatting over coffee, remember everything I've shared here is just recapping publicly available market info and reports as of December 15th, 2025. This isn't meant to guide your decisions or predict the future. Markets can turn on a dime. I'm not a financial advisor, so please don't take this as advice to buy, sell, or hold anything. Always dig into your own research. Maybe chat with a pro who knows your setup and stay informed through reliable sources. Thanks for watching.